All right, we got to go deep dive today on mortgage rates, upcoming things that are going to impact your potential home purchase this year. So get your dive gear on and let's jump in. What's going on, everyone? It's January 11th today. We're going to do a deep dive into mortgage rates because basically since the first business day of this year, rates have been moving for the worse every single day. I started to record this yesterday, but I had like a hunch that we might see a turn for the better. This morning, it did not turn out that way, but in the last hour, it did turn for the better. So I'm gonna show you a lot of things today. One, rates are going up. How does that impact your home purchase price? Most of us pick what our price point is based on our comfortability and monthly payment. The higher rates go, the monthly payment will then result in a lower price point. So we're gonna look at how that impacts you at 0.5% increments, because we've already seen a 0.5% move. From December to now, we've seen interest rates rise in many cases by 0.5%, which is a lot. So I'm going to show you what's going on in the market, mortgage-backed securities trading. We're going to look at how rates impact your max purchase price from a comfortability perspective. And I'm going to show you the trend back looking at where rates were pre-pandemic, because where the market is the same as where it was pre-pandemic. So we're going to look at where rates were compared to where they are now. So this may be a little bit longer video, but it's going to have a ton of information. If you're thinking of purchasing a home this year, this will be important. All right, so here we are looking at mortgage bonds trading, mortgage-backed securities, and this is a 3-month look back. So remember, with these charts, up is good, down is bad. Up means better rates, down means worse rates. So back here, November 5th was kind of the best level we've seen in the last 3 months. We were sitting at about 104.6. Today we're sitting at 102.6. That's 200 basis points in movement. That's a pretty dramatic shift. Even though it is over, 2.5-ish months, that's a lot. And we've just gradually been going down. As I've done these rate updates, I've said rates are going to get worse. Inflation is driving rates for the worse. When money has less value, you will be charged more for it. Interest rate being the charge. Remember, the Federal Reserve started to taper their purchase of mortgage bonds and treasuries in November. So that was another cause of this. If they're buying less, a lot of investors are buying less, which is also causing rates to rise. So there's a lot of key factors kind of coming together right in the first couple weeks of 2022. So we want to look even further back. Now let's look at where we're sitting today over the last 2 years. Like, where were we pre-pandemic? And that is a very interesting thing to look at. Back to 2 years. I'm going to pull this. Okay, so here we go. This is as deep as we can go. Here is January 2020. So if I draw a line from where we're sitting currently, there's really nothing to hold us here. I mean, we had one day when everything was volatile. This nonsense that you're seeing right here, that was all when the markets went absolutely insane. We didn't know what was going on. But there's nothing really here. What I was looking at is our next level would basically be right around here. You can see that we kind of had a flat line here. So hopefully we don't get there. If we get to there, rates are going to be even more worse. Remember, as this chart goes down, rates get worse. But here's our silver lining. If I go back and we look at the last quarter, today has been pretty important. So what you'll see is today is Tuesday, Monday, Friday, Thursday, Wednesday, Tuesday, Monday. So this is the first business day of the year, January 3rd. Rates got worse every single day. And what you'll notice is they would have a little tick up at the end of the day, but then the next day would open right where the last one left off. Next day opened right where the last one left off. So even though we had a little bit of recovery those days, the market opened yesterday right where it had left off. Today, we saw the same thing. So we actually opened in the same place. Rates, the market got worse, meaning rates would have been worse. And that's a pretty dramatic shift. We go from 102.65 down to 102.36. That's about 30 basis points. 30 basis points may end up being roughly an eighth in interest rate shift, but we got a good bounce. So we got a good bounce and it started to recover. So now what I'm looking at is hopefully this is our floor. We don't fall lower than this and we start to recover in the other direction. Now, where were rates pre-pandemic? Where are they today? Sean, what's the number? So let's look at that. So Freddie Mac has a great chart that shows you what rates look like, and they'll go back to 1971. So February 2020, pre-pandemic, rates were sitting about 3.5%, January about 3.62. If we look at where the market is now compared to that, so we have our green line back in February, we're right at the same point. Rates right now, I would say on a conventional 30-year fix, $625,000 or less, 20% down, great credit, all those things. This is not a guarantee to lend. This is not a rate quote. This is just giving you an example. I would say rates are sitting about the same point they were February and January of 2020. The market has gone back down to the same levels we saw pre-pandemic, which means the rates are about the same as they were back then. Now, how do these rates impact my home purchase? Let's look at that. All right, so what I've done is I've built out a comparison using, let's just say you said, Sean, I want my monthly payment to be roughly $2,500 a month, all in, taxes and insurance included. That's the example I'm using here, $2,500 a month as our fixed variable. So at $2,500 a month at a rate of 3%, which is what we were seeing kind of November, December. I'm using round numbers, might have been 2 7/8, might have been 2 3/4, but trying to keep this as round as possible for comparison purposes. So at 3%, purchase price of $560 with 20% down would have you right around that $2,600 monthly payment. Now, rates going up to 3.5%, that same payment, $2,556, or within a few bucks of each other, you're buying a house that's $30,000 less. This is a very important piece of this puzzle. Everyone has been saying, the experts say when rates go up 1%, we should see home prices come down $100,000. Well, one, that doesn't even make sense. If a home was $200,000, you're telling me magically it's now going to be worth $100,000? It doesn't make sense. It should be more of a ratio-driven approach, a percentage-driven approach, more than a dollars approach. Anyways, what we're seeing here is even if prices went down, your payment stays the same on a lower priced home at a 0.5% increase in rate. So if we go 1% to get to $100,000, if that worked, let's just say the experts were right and interest rates went up 1% and prices came down $100,000, your monthly payment will be higher as a result of the rate. I've always said, go back and watch all these other videos I've done. The cost of money, the interest rate, is far more important than the price of the home. It's hard for us to wrap our head around that because anything we buy, we want the lowest price. Well, when you're buying a house using a 20% down payment, 80% of the money is coming from someone else. So shouldn't I care about what that 80% is going to cost me? That is the most important piece of the puzzle, and some people are learning that the hard way right now. Let's say rates continue to rise. So let's say rates go up another 0.5%. Your same payment of $2,500 a month now has you down to a price point of $505,000. So at 3%, November, December of 2021, a $2,500 month payment would have you at about $560,000. If we go to 4%, 1% increase, you're going to be buying for about $505,000 and the payment's the same. A lower priced home does not equate to monthly savings, unfortunately. So where do we go from here? I'm hoping that today is our turning point and we start to recover on interest rates a little bit. There's been a lot of fear in the market. We've got Omicron running people ragged and scared. So there's been a lot of little things going on that I think are driving that fear. Hopefully today is that turning point. But remember, if you buy a house today, let's say you buy a house tomorrow. Let's say rates do go to that 4% number, right? And 4, we haven't heard that. We've been hearing 2s and 3s. And Sean, now you're saying 4? Well, if it went to 4% and you bought a house at that point, and then rates went back down, just refinance. So let's take 2020 as an example. The pandemic drove interest rates down dramatically. I had people buy homes in February of 2020, refinance 2 months later. The house is what's important. Get into your house, get onto the right side of the appreciation we're going to continue to see, and just know that your cost of money can decrease. If interest rates go down, you can always refinance. And if you bought a house and your rate was 4% in, let's just say it got there in the next 2 months, well, if rates then went to 5%, how do you feel about your 4%? You can always change what you have if interest rates improve. That's the whole purpose of a refinance. So there's a lot to talk about here. Let me know what questions you have. Comment below. I'm happy to help any way I can. Thank you so much for watching this. I know it was a longer video, and I hope you have a great week, and I'll talk to you soon. Cheers.